You're listening to the Financial Source podcast on YouTube.
Okay, so let's try to unpack the mood out there right now. If you look at the global markets, it really feels like the whole room has gone quiet.
Mm-hmm.
Everyone is just holding their breath, waiting for that U.S. non-farm payrolls report to drop.
It's a massive wait-and-see vibe. Nobody wants to make a wrong move right before we see that labor data.
But, and this is where it gets really interesting, if you look at the Asia-Pacific region, there is a serious outlier.
Mm-hmm.
Australia isn't just treading water.
No, they're having a full-blown party. It's really a split-screen moment.
Right.
While the rest of the world is kind of paralyzed by this Fed watch.
Right, waiting to see what the U.S. central bank does next.
Exactly. We're seeing these very specific, localized stories driving all the action in the APAC region. So for this deep dive, we've got reports on equities, some major currency moves, and commodities. The mission is to figure out why Australian banks are defying gravity, why China's stimulus isn't really working, and why oil traders seem to be ignoring bearish data. Let's
start with that outlier then. The ASX 200 in Australia. I mean, it outperformed its peers significantly, jumping 1.5%. In a market this nervous, that is a huge move.
It is.
I saw the Commonwealth Bank of Australia, CBA, they posted a 5% profit jump. Is that the whole story?
It's the engine of the story. Financials are the real heavyweight on that index. But the insight here isn't just that they made money, it's how they made it.
Okay.
Remember, we're in a restrictive rate environment. There was this prevailing fear that high interest rates would crush the economy and, trigger a wave of bad loans.
Right, the mortgage cliff everyone's so worried about. Borrowing gets expensive, people default, banks lose money.
Exactly. But CBA's results signal the complete opposite. They're managing their credit quality, and those high rates are actually padding their margins. So investors looked at that report and just realized the banking sector is far more resilient than the doommongers predicted.
And that confidence is what allowed Australian equities to just completely decouple from the caution we're seeing everywhere else, which stands in such stark contrast to the mood in China. Their markets barely nudged up, 0.3%?
Yeah, barely.
It feels like they just can't get the engine revving.
Yeah.
Despite the government trying to pour fuel on the fire.
It's a crisis of confidence. You have the People's Bank of China promising appropriately loose policy, basically turning on the money tap.
But it's not working.
No. The economic reality on the ground is just tough. The inflation data came in weak. The consumer price index only rose 0.2%, which missed expectations. But the real red flag is the producer price index.
The PPI. That's the price at the factory gate, right? Before it even reaches consumers.
Correct. And it is still stuck in negative territory. That is textbook deflation. It highlights this huge industrial overcapacity. Chinese factories are making way more stuff than anyone wants to buy.
So they have to cut prices just to move inventory.
Right. So even with all that government support, the structural fragility in domestic demand is just keeping a lid on any real market enthusiasm.
And this divergence, it's spilling over into currencies, too. The Australian dollar is having a moment. It reclaimed the 0.71 handle. For listeners who don't trade Forex, that means it broke back above 71 U.S. cents. That's a 3-year high.
And that surge is directly tied to central bank messaging. While the U.S. is looking kind of soft, we had an RBA official, Hauser, come out with some very hawkish comments. He explicitly said inflation is still too high and policymakers will act as necessary.
So he's basically telling the market, don't expect rate cuts anytime soon.
Precisely. And money follows yield. If Australia keeps rates high while the U.S. potentially cuts, investors are going to park their cash in Aussie dollars.
And we're seeing similar strength in the yen, but for a different reason.
A different reason, yeah. The market is sort of sniffing out that the Bank of Japan might finally be ready to normalize policy, so raising rates from rock bottom.
Even with Japanese markets closed for a holiday, the yen still moved. That just shows how aggressive the speculation is.
It's all about those yield differentials narrowing. Traders are front-running a potential shift in Japan, just as they're rethinking the U.S. dollar ahead of that jobs report.
Speaking of the U.S., futures are edging higher, but it feels more technical than anything, just a holding pattern. But commodities didn't get the memo to stay quiet. Oil bounced back 0.6%.
Oil is finding support, but it's fragile support. Fundamentally, the price should probably be down.
Because of the inventory builds.
Yes. We saw U.S. inventories build up more than expected, which usually pushes prices lower, supplies high. But that was completely overridden by geopolitics.
This is about the comments regarding Iran, right?
Yes. President Trump made remarks about potentially deploying a second aircraft carrier strike group to the Middle East, specifically regarding the Iran negotiations.
That definitely adds a risk premium to the price.
It does. With another round of talks expected next week and warnings of tough measures, if those talks fail, traders just aren't willing to bet against oil prices rising. They'd rather ignore the inventory data than get caught short if a conflict makes the price spike.
So, to wrap this all up, we have Australian banks thriving on the very rates that were supposed to hurt them.
China is stuck in a deflationary loop despite all the stimulus.
And oil prices totally detached from supply data because of tensions in the Middle East, all while the rest of the world stands still, waiting.
That's the snapshot. It's a market defined by localized stories right now, not a single global trend.
Which leaves us with a provocative thought to end on.
Well, we've spent, the last decade in an era of synchronized global economics where central banks moved more or less together. But now the RBA is hawkish, Japan is looking to tighten, China is loosening, and the U.S. is in limbo.
A total mess.
It raises a really important question. Are we entering a phase where central bank policies completely decouple, finally ending that era of synchronized global economic moves?
Something to keep an eye on. Thanks for listening. We'll catch you in the next deep dive.